Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of Thor Financial Technologies and Portfolio Manager of THLV, the Thor Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. Today we have John Davi. He is the founder of Astoria Advisors. We talk about their ETF, ticker PPI, which is an inflation-sensitive strategy. We talk about John's business. John, like us, runs a model business as well as an ETF, so it was interesting to get his perspective on both. And I think you will enjoy hearing about their inflation-sensitive ETF, especially after everything we've gone through in terms of inflation over the last handful of years. So please enjoy this episode with John Davi. Hey, John, welcome to the show.
Good to be here. Thanks for your time.
So John is from Astoria Advisors. He's got an SMA business, kind of an OCIO business, some research in there, I believe I saw, and the ETF we're going to talk about, PPI. But before we get into that, why don't you tell me a little bit about your background and how you got to starting Astoria Advisors?
Yeah, sure. So spent 20 years doing institutional research, portfolio construction for firms like Merrill Lynch, Morgan Stanley. So 10 years at Merrill Lynch, 10 years at Morgan Stanley. Started my career actually in quantitative research. So, kind of late 90s, I know quantitative analysis, portfolio construction is very much in vogue, but, back then, it was all about single stocks and fundamental research and, being institutional II ranked, like that was the big thing in, research and even at the sell side. From a standing start, it was always about how do you build portfolios that delivered, unique sources of risk and return for institutional investors. Always had a macro kind of lens. So, the goal was to always join the buy side and to be an entrepreneur. And I just thought that it'd be helpful to kind of do both at the same time. So 2017, started Astoria. And, the firm has been growing since 2017. Myself and my other, kind of partners and colleagues, all have an institutional caliber background, either worked on the sell side, whether they're in sales, trading. We've got a couple of younger analysts and they've come out of school, but, they very much are being, kind of engulfed in this institutional caliber research and portfolio construction. So that's a little bit about us. We do service other RIAs, other independent advisors that are looking for outsourced solutions, whether it be, strategic asset allocation, quantitative stock selection, and obviously now we have the PPI ETF too. So that's opened us to a whole new can of worms.
Yeah, and I want to talk about all that as we kind of move forward with the conversation. But before we talk about the business stuff, I always like to ask each guest, what do they like to do for fun? You have any hobbies outside of just working?
I got 3 kids, 2 teenage daughters and a 2-year-old son. So my time is very much spent with my family. It's July. It's going to be July, late June. But, I'm starting to do my kayaking and biking and cycling. So I like to do outdoor activities. As I get older, I definitely appreciate the warm weather more and more. I very much, enjoy kind of, sports. Grew up as a diehard kind of New York Mets fan, Jets fan, Knicks fan. So it's been quite a struggle speaking to somebody that's from Pittsburgh that has had a lot of success with their sports teams the last 20 years. But, between sports and family and physical activity, those are my kind of passions.
Yeah. Well, other than the Pirates over here, you're right. We've been pretty fortunate. And like you, I also have a 2-year-old son. So you and I are going through the same thing right now, but they're getting to the fun stage. So
yeah,
it's not too bad anymore. So primarily I want to talk to you about PPI, but before we do, let's talk about Astoria Advisors as a whole. So you kind of touched on who you work with. So you work with registered investment advisors, but maybe let's dive in a little bit more into what you guys do. We have a very similar business, except I noticed when I kind of looked at the ADV, do you also custody assets as well as provide model portfolios, like outsourced model portfolios as well?
Okay, good question. So custody is a very legalish term. Let me drive the point home. A lot of advisors we work with, like they don't want to touch the portfolio too much, deal with corporate actions, rebalancing, tax loss harvesting. So we empower advisors by building solutions. And then they really do like that we're actually physically doing the trade in, the rebalancing, corporate actions, raising cash needs. So, I think some of my peers, and I'm not sure what your firm exactly does, but like they'll have like their, strategic asset allocation model on a TAMP, like SEI InvestNet, and say, we're the best thing on earth by our strategies on InvestNet. We've kind of decided that we, didn't want to take that approach only because standing start, the firm started in 2017, you didn't have like a track record, let's say. Second, I just think like if we could be the vanguard of like, the SMA world and just give people a lower price point, the investments of the world, the SEIs, listen, they're publicly traded companies. I get it. And they have some pretty serious backers, but it's also pretty expensive too, right? 30, 40 basis points. I think like, the way we operate where, we could be a lot more hands-on, right?
Mm-hmm.
Like, so you can get 10,000 strategies on InvestNet. It's probably overkill. We deliver you those blended ETF models, those strategic asset allocation portfolios. We've got a suite of quantitative stock models, and then advisors like mixing and matching. So a little bit of stocks, a little bit of like short duration bonds in order to like target a standard deviation. So in our ADV, you'll see that we have like maybe 300 plus million in assets that we physically touch. We call that physical sub-advisor. The rest of it is where we're outsourced CIO, where somebody's hiring us and saying, okay, John and his team is going to help actually build the portfolio, but we want to do the portfolio management ourselves. So that's what we call like OCIO work, and that's considered like AUA per se.
Yeah. So we do more of the OCIO work rather than physical touching the assets. And that's interesting. You're almost like providing TAMP-like services while still providing your strategies, which I think is extremely useful because you're right. Some of these larger TAMPs can get expensive, and you're also right that there's way too many strategies on there for advisors to choose from. So I really appreciate you kind of going through that because when I was going through it, I wasn't sure if you had a separate business where you were working directly with clients, but it just sounds like you're working with RIAs directly and totally. So
independent RIAs that, like sub, $500 million, but that's kind of the sweet spot. Once you get past $500 million, they have their own trader, their own CIO, and then it's like, we become less appealing to them per se. But that's been the business plan so far, and maybe that evolves over time. But for now, I think like the firm kind of prides itself in our research and how we build portfolios, and then the add-on is like the operational aspect of what we do.
So in terms of building portfolios that these RAs are utilizing, how do those investment decisions get made? How are you building those portfolios? Is it much like the quantitative lens that you worked in prior, or kind of talk about your investment philosophy as a whole and how you're making investment decisions?
So the goal would be, so we have a couple of pillars, and we have like a slide deck that I could, kind of point, watchers and listeners to, but, we believe in after tax, after inflation, risk adjusted returns. So those are some pretty serious words. After tax, that's important, right? That's what tax loss harvesting. So you go on a TAMP, they're not going to tax loss harvest. I don't think nearly as frequently as we can. The beauty of ETFs is that once you get in those big building blocks, like, large cap, mid cap, let's say, like, there's a number of ETFs you can tax loss harvest. So after tax return is quite important. After inflation, that's a big thing. We've always had inflation linked assets in our models. since 2017. Usually it's been gold. There's been times where we own physical commodities via the ETF, but we've always hedged inflation risk, whether it's 2%, 9%, or now 6%, 5%. Like that compounds, especially when you invest for 20, 30 years, like 2% a year for 30 years is meaningful.
Yeah.
So I just talked about after inflation. I talked about after tax. So risk adjusted is interesting. Like, okay, you can generate, and, Harry Markowitz just passed away, rest in peace, risk adjusted returns. Like, you can just own growth stocks, call it a day, 7 FANG stocks. That's a lot of risk. I know you're being compensated this year, but last year maybe you weren't. Like, so, there's things that happen. I just did a call with an advisor walking through like our risk-based ETF models and like showing him the return differences between like our 50-50 stock bond portfolio versus like our 70-30 stock portfolio. Like there's things that in bonds, there are parts of the bond market where there's embedded risk premium where you can capture. So we like to use stocks and bonds and alternatives because, the way we manage our portfolios, like there's just things that we know are going to happen with all those 3 components: stocks, bonds, commodities, and alternatives. And they can generate a much more smoother portfolio experience. So our investment discipline is macro plus quant. I find firms are either macro focused or they're quant focused, but it's rare to have both. So in an ideal world, like, we have, let's say, a 70-30 stock, 70-30 equity bond portfolio and / alternatives. Like we're investing across different factors. Factors are cyclical. Some work better than others, depending on where you are in the cycle. So we like to harvest a portfolio factors on the equity side. Same thing with the bonds. And, like we use alternatives to kind of hedge our downside risk. So that's kind of it in a nutshell. We've got something on our website called Cycle Indicator Deck, where it walks through 60 slides, walks through each one of our indicators. Where are we in the cycle? We have like a lot of bifurcation in data today. We're doing this podcast on June 27th with some strong housing data, some strong building permits announced today. Market's doing quite well. That's good, but there's a number of other indicators I think that are not as attractive, or, maybe they haven't reached their inflection point. So we're at a tricky point in the cycle where, rate cuts are not on the horizon. In fact, we're still talking about rate hikes, here in the U.S. So, that lends itself to how we're thinking about portfolio construction, how we want to be tilted across U.S., international. So that's a little bit about our portfolio construction process.
Let's dive into that just a little bit deeper. So depending on where you are in terms of that cycle thesis using your indicators, is that going to change the asset allocation inside of your portfolio? Let's say it's a 70-30 portfolio, and you're in a certain part of the cycle. Let's just say you're in a cycle, you believe that the market might go through some volatility or some downside, or we might have a recession. Are you going to be tilting that portfolio actively to make it less risky, or is it just in terms of providing insights and research to clients?
So good question. A lot to unpack there. I would say that what we're trying to do is, okay, so we kind of identified going into this year that, we were kind of late cycle. If you went to our outlook report, we said there were 3 things that the market was pricing in: an earnings recession, economic recession, and then, some like DEFCON 5 downfall in the S&P, right? Like another 20%. So we thought there would be one of those 3, like all 3 were not going to happen, right? Economic recession, earnings recession, and another DEFCON 5 drawdown in the S&P. By the way, we had one last year, right? S&P fell something like 28, 30%, closed down in the year 18, but we rallied significantly, from October 12th through the end of the year. So, basically everyone missed this call. We said that we thought there were some green shoots too, like China reopening. And that was, I think, pretty important. I think, what we missed pretty big this year was like the fact that $1 trillion of fiscal stimulus was added to the economy. So things like, the SNAP program, extension of Medicaid, the student loan, program. So, it's funny, like then you had like the Silicon Valley Bank, crisis, and that added more to the Fed's balance sheet. The point is like, we do look at these things. Like we just decided this year, like, okay, like we still want to be relatively defensive because we do acknowledge that even though I just said like building permits were good, the housing data today was good, there's a number of other indicators I can point to that show that like, okay, maybe the earnings, outlook for the second half of the year is too rosy, let's say, right?
Mm-hmm.
Maybe, there's leading economic indicators, OECD, that are still trying to find a footing, right? So we just want to be honest and acknowledge, okay, there's some good, there's some bad, but overall, like not everything aligns all at once. You don't get the green light on every
Sure.
indicator, but like let's be strategic with our tilt. So, okay, instead of owning just a massive amount of treasuries, let's nibble on high quality corporate credit. So things like SPIB, we kind of added to our portfolio. In case the economy does go into recession, let's buy some SPTL, like the long dated, part of the bond market, which has a lot of convexity, is very sensitive in case a recession hits, right? Let's add, we had lower beta, so let's add some beta, but let's do it in like things like IHDG, international high quality, ETFs. So that's how we're thinking about portfolio construction. Like we're not tactical. We do look at where we are in the cycle, look at these various indicators, and then we try and strategically tilt once, twice a year. It's a core satellite approach. So you've got your core tickers, which in theory shouldn't change at all, ever. And then you got your satellite. Your satellite can, and I'm not talking about buying like XLE as a satellite.
Right.
To me, XLE is like a tactical decision. Like, that's separate, right? Like
Right.
your money, that's not a core strategic ticker, let's say. But a satellite could be like, okay, like small caps, right? There's an embedded risk premium. Small cap stocks do well over time, but clearly they're not good when the economy is slowing, right? So like we would have sold our small cap ETF last year, right? I think like if I'm thinking forward in a year, if we get some like reacceleration in economy, these OECD leading economic indicators inflect higher, then we're going to see like things like cyclicals inflect higher, small caps inflect higher. So we would like start to enter into a position in some of those tickers that we like, maybe next year, right? Q1, Q2 of next year as we see the cycle play out.
This is super interesting, and I hope you don't mind. I know we're here to talk about PPI, but I find your portfolio construction interesting, and I like this idea of having really a passive tactical piece with a satellite side of it that can kind of be a little bit more tactical, right? You said it's not tactical, but it sounds like you're looking for some spaces to be able to take advantage of some opportunity. So let's just stay with the 70-30 portfolio, 70% equity, 30% fixed income. What portion of that portfolio is going to stay kind of core passive, and how much are you going to sleeve away to be, as you call it, kind of satellite?
I try and keep it where it's like half the portfolio is tickers that aren't going to change. The other half are up for review with the goal of like no more than like 30 to 35% turnover on average per year, assuming that like it's normal market conditions. Sometimes they just could be like a big ticker swap, like not that we're tactical, but we made a decision years ago to kind of split our currency risk, like half currency hedge, half unhedged. So like that was like a decent sized ticker swap, but that's not like us being tactical.
Right.
We just subscribe to the idea that like, are you getting paid for owning, kind of taking on the currency risk? I think some of our alternatives have evolved over years. So so you mentioned 70-30, but that 30 bonds is going to be like half that bonds and half that alternatives.
Mm-hmm.
So things like merger arbitrage, I think works well when you have like a booming economy where people feel, especially when you've got a lower interest rate environment, that's for sure. That's the best for merger arbitrage. Whereas now you got the opposite, right? You've got like a slowing economy, high interest rates. So if you look at like all the investment banks, like they deal count their IPO, it's like at a standstill, right? Or it was, because corporates are just trying to get understanding of how do you live now in a world where you had zero interest rate policy for 15 years and now you've got 5.5% on Fed funds, right? So like our alternatives have meaningfully evolved. Things like PPI, like, made it into our portfolios, kind of year and a half ago. that's a decent sized allocation. Our alternatives, like that evolved because we felt strongly about inflation. So half of it is like kind of stays in the portfolio. Half of it is up for review, depending on where we are in the cycle.
Yeah, that's interesting. Thanks for explaining that to me. Kind of one last question, because you and I are both in this, model business outside of the ETF. What do you find to be most frustrating for you in that business? I know I have my opinion, but I'd like to get yours.
What's most frustrating in the models business?
Yeah, well, here, I'll give you mine. It's really frustrating to me. We have, I don't know, 10 models. It's really frustrating to me when we sit down, with an advisor and we lay out a really nice asset allocation between our models, but one sleeve of that asset allocation does really well, and they want to strategy chase it, and then all of a sudden, they're making a tactical move within our strategies to kind of chase performance, right? Whether it's a single stock growth model, it's happening this year, right? Growth, obviously, tech was bad in 2022. Model didn't perform well. It has started off the year with an absolute bang, and now everybody wants to chase back into growth and back into specifically unprofitable tech growth. So that for me is very frustrating. And I don't know if you have the same problem, or if you have your hands on the steering wheel a little bit more than maybe that we do.
No, I think we have the same frustration. Performance chasing is real. I think there's a lot of people that talk about this, like how long can you let a strategy underperform, right? I mean, you should have 3 years, 5 years, 10 years. Like let a manager kind of play out their views. What you'll find on us is that because we allocate towards alternatives, and alternatives, let's say, are a drag on portfolio. We look at alternatives as insurance, right? Like you need an event to happen for the insurance to kick in, like car insurance, right? You get into a car accident, boom, your premium that you pay every year finally gets put to use, right? So we just need like events to happen for our models to kind of outperform that benchmark. Straight up bull markets, delta long, 7 stocks driving the S&P is tough when you're global, when you're diversified across factors, and you have alternatives. So I think if you look at our fact sheets, we have trailing 1, 3, 5 since inception returns. You'll determine what you think of that. But you do need years and years to go by for these views to play out. Same thing like PPI. We had this view about inflation. In June of 2020, I went on CNBC and I said, I was on Bob Pisani's ETF Ed show, and I said, look, in my economics 101 class, they told me that if you restrict supply, you increase demand, prices go up. And back then, this was before COVID. Remember, COVID was announced in November 2020, the day after the U.S. election. And nobody was talking about inflation. Nobody was so it took a while for the thesis to play out. That was equally frustrating. Okay, we told people, hey, we think we could have a problem. Let's hedge your inflation risk. So, for our inflation sensitive model portfolio, we cobbled together 10 tickers, and then we added that as a sleeve to our core strategic models. And then we had this big boom in inflation, it went up a lot. Now it's coming down. And, that also gets frustrating too, because, we could talk more about PPI and how it's been doing and its portfolio construction. But yeah, I think, the time is of the essence when it comes to advisors, and they have very short attention spans.
Yeah. Yeah, I find that as well. So one last question before we dive really deep into PPI. With all of these other strategies that you run, do you have plans to launch any more funds, or is PPI going to be your single strategy, or I should say your single ETF moving forward?
Well, I think we're at an interesting position because, we do have, some success with PPI, and it's opened our eyes to okay, what could the future look like for us? So I think we're never going to be the next, iShares or WisdomTree or Pacer ETFs. But if there's a few interesting tickers that we can bring to the market that'll help solve an internal problem that we're having, I think that could, my frustration with, okay, you start with the S&P, right? That's got 33% in technology and communication stocks. So to me, that's an issue, just because there's too much sensitivity to one sector, and valuations have gone up, and now the S&P is back to being expensive. And then now all the smart beta ETFs are optimized against the S&P. Like everything is against the S&P. If you think the S&P is flawed, your smart beta ETFs is going to be flawed too. So like it's making our portfolios somewhat concerning when it's like, and these smart beta ETFs, they're passive, right? So how do they go
Right.
from passive to now be more active? Like I do think you want to be more active given where we are in the cycle. So
Yeah, I would agree with that. So let's talk about PPI, which is inflation sensitive ETF you guys run. The narrative and the ticker, I'm assuming, I should say the environment and the ticker symbol itself has probably been good for you, especially with inflation ramping, and you got the perfect ticker for inflation sensitive ETF. So can you explain what PPI is meant to do? And then we'll talk about how the investment process works and the selection. But what is it really designed to do?
So it's designed to kind of help a multi-asset portfolio deal with inflation pressures. Okay. In a nutshell, that's what it's trying to do. It's trying to give you exposure to different parts of the capital market system that are going to be sensitive to inflation. At the end of the day, like these are growth sensitive, business cycle sensitive sectors. So we're leaning on energy, we're leaning on materials, industrials, a little bit of financials. That makes up the equity side. We have an allocation towards commodities and commodity equities, and then we have a little bit of exposure to tips. So it's a multi-asset class ETF, but basically the way that I think we're thinking about portfolio construction is that different parts of the inflation sectors are going to respond differently depending on where we are in the inflation cycle. When we first launched, inflation was rampant, right? We developed the SMA, in 2020. We launched with Access Investments. They're the advisor, we're the sub-advisor. We launched it on December 2021. So like CPI was just kind of trending higher and like really going from like, I don't remember the exact numbers, but we launched it and it was still trending like 7, 8, 9, right? So in that very acute stage of sharp inflation, we leaned very heavily on energy, materials, right? That was also corresponding to like Q1, the Russia attack of Ukraine in 2022. If you remember, the S&P kind of fell apart in 2022, right? Inflation was rampant. The Fed had to go very aggressively, right? So then the ETF evolved, right? Because then we got to a point where the Fed was hiking interest rates very aggressively. It pushed up real rates, right? And then we were leaning more towards tips and other parts of fixed income. So it evolved like where it got to like 85% maybe in cyclical stocks and these energy, materials, industrials. We've since downgraded where we're actively managing it, right? So now it's about 72%, 73% cyclical stocks, natural resource stocks, commodity equity stocks, about 10 to 15% physical commodity, mostly in gold, and then 10, 15% ish in tips ETFs. So one ticker solution that kind of gives you exposure to different parts of the inflation cycle. But the point is those are the four sectors it leans on is energy, materials, industrials, and financials, because those are the ones that are very sensitive to the growth cycle and to the business cycle.
Yeah. So you kind of hit on this in terms. Sorry, did you have something else you wanted to add?
Yeah, just one thing. I mean, the P ratio currently right now is about 8. These are cheap stocks, right? It's very difficult to find cheap stocks in an era where the S&P is 20 times forward earnings. I've seen periods of my career where energy stocks are much higher in terms of valuation. When I started my career, energy stocks were north of 15% of the S&P sector weight. There's been times where it's like 20, 25, not in my career, but like in the 70s. It's this interesting point, right? Because energy got down to like 2-3%, because of the last decade, it's all been about tech and, ESG type stuff. So it's just interesting how these sectors, have just, that's why it's a nice complement in a multi-asset portfolio that's got a lot of tech duration risk, nominal bond risk. So we're using it as an alternative in order to hedge the other exposures in your portfolio. You're not dumping SPY to buy PPI. That's not what you're doing. you trim back some of your equities and allocate towards PPI. And in 2022, when S&P was down 18, PPI was up 4, right? Past performance on indicative future results. That was 1 year, but like it was an inversely correlated alternative last year. This year, S&P up 15. PPI is kind of flat in the year, depending on the day, up 1, maybe up 2, down 1, down 2. So, different return profile this year, but at the end of the day, these are like a 7P ratio, right? It's very, very cheap.
So how are you looking at, I understand all of that, but in terms of actually picking the underlying names in the portfolio, how does that security selection process work?
So that's the kind of true north of Astoria, quantitative, systematic portfolio construction on the stock side. So outside of our ETF managed portfolios, we have like quantitative stock portfolios for advisors that want it. So it's a robust screen. We're looking at, ultimately at the end of the day, we're looking for cheap stocks with strong growth prospects, good momentum, that have shown sensitivity to CPI historically and that are high quality in nature. So looking at those 4 sectors that I mentioned, and then mining for the alpha and the beta, 5 US stocks, 5 non-US stocks. So kind of 40 stocks, let's say in general. And then there's like, some ETFs for like our tips and commodities exposure, but it's very kind of rules-based, systematic. The active element is like how we allocate across stocks and bonds and commodities.
Yeah. And then in terms of weighting decisions, and also, rebalancing, since it's an active fund, I'm sure you rebalance unless you have a rebalance schedule. But as far as weighting inside of those different pockets, is that decision also fluid, or do you have kind of guardrails on the weightings in terms of the difference between equities and tips and all the other buckets?
Yeah, so good question. So it is not a tactical strategy where it's going to go to like 100% tips because we're thinking about like de-risking because, I don't know, there's some invasion in Ukraine or something like that. Like that's not what it does. Like, of course, we're active, so we don't have to like have a rule in place where we say, okay, we're going to be like no more than 20% fixed income. To date, we've been running it for, a year and a half. We've kept the bands like 70 to 80%, 85% stocks, 10, 15%, kind of tips, somewhere around there for commodities. Rebalance is like twice a year. Okay. We can review our, tilts across the asset class level quarterly, but it's not meant to kind of go 100% gold because, we have like an issue in the global economy, and that's not what it meant to. Like, we just had this view. It's like these stocks are so cheap, like we feel like we can lean on those stocks, especially if it's put into like a multi-asset portfolio that has like large cap core, large cap blend exposures, because those by definition are going to have a lot of technology stocks, which by definition are sensitive to rates, sensitive to duration. And evidence number one is like what happened to tech and stocks when, interest rates went up a lot in, last year. So.
Yeah, so that actually feeds into one of my questions, which is if you're talking to an advisor, a new advisor, you don't have a OCIO relationship with, you're not running an SMA for, how would you kind of talk to them about using PPI in their already diversified model portfolio suite? Like, what type of allocation would you suggest, and where would you put that in kind of a model portfolio for an advisor that already has an existing suite or an existing model portfolio they're running?
So I think it should come more from the equity side, because that's what like if you sell equity, like if you sold your bonds to buy PPI, like, think of PPI as like a 70 equity, 15 bonds, 15 commodities, right? So you should kind of proportionally trim your exposures that way. I think like the way we've done it, which is use it as an alternative, and just kind of look at it as like an inflation insurance, right? As long as you, like, I have car insurance, right? It costs us $2,000 in New York to, cover 2 cars with 2 drivers. Yeah. Like, no matter what, like, we're going to spend that $2,000, and God forbid we get into a car accident, Geico's going to like, help cover the cost, right? But we have a deductible. You don't have a deductible on PPI. But like the point is, like, I don't try and time my car insurance, my home insurance, my life insurance. We just have that premium, you know, and I said, like, we just have this view, like our pillars are after tax, after inflation, risk adjusted return. PPI, I think, demonstrated last year that, it did well when you had rampant inflation. Our firm view is that we're going to be in a high inflation environment for many years. By the way, Brad, if I'm crazy, right? CPI has gotten 2%, like maybe it was below 2%, but like the point is every year there's inflation, right? So
Right.
as long as you size it, so I think like 3 to 5%, depending on how much equities you have in your portfolio, I think it's going to be there and it's going to past performance not indicate future results, but that's how we view PPI as an alternative inflation insurance.
Yeah, no, and I would agree with that. And so as we wrap up here, I think that was a great dive into what PPI does. And I just would want to ask some questions about how you're going about marketing the fund, right? What are some of the things you're doing? I talk to a lot of managers on here. I talk to people who are in the service side of the business. And the number one thing is it's really hard to get out there and sell these things. So how is your firm, how is Astoria kind of positioning PPI, and how are you getting out there and trying to sell it and grow the fund?
Yeah, and so Axis Investments is the advisor. So they're primarily responsible for sales and marketing. We're the portfolio managers. I'm a content generator. So it's helpful because I come with a big, kind of media presence, and this is what we do. Like we're a sub advisor for a lot of RAs, so I know exactly how to like communicate the message once we get people on the phone. I don't want to speak on behalf of Access, but they've got their own distribution channels, digital marketing. They've got a process for kind of how they, email campaigns and drip campaigns and whatnot. So let me bring that question to like what I see other issuers do, without
Sure.
naming their names specifically. But I think in general for ETF small niche players like your firm, our firm, Access, and other ones that are sub couple billion in assets, like you've got to have like digital marketing presence. You've got to be a content generator. You got to like, you're playing in like you're fishing in a pond that's got a lot of fish. So like, how do you stand out? And I'm a big believer on if you can bring assets to the table, that gets you to like the first hump, right? Because the pushback you always get from people is, okay, what's your size, right?
Yeah.
So if you're like 3 to 5 million in assets, like you're on doomsday scenario.
Yeah.
Once you start getting past 50, 100 million, like the ETF like starts to have like a life of its own. So I'm a big fan of like creating digital content, digital marketing, just talking about markets like portfolio construction. Okay, what is this firm view, Astoria, about markets and the Fed? And then, that builds you an online presence with people.
Yeah, I think the most frustrating thing, and we've kind of we're now in in that $1,500 million size. The most frustrating question was or rebuttal to when we would talk to advisors is, well, it doesn't have any volume, and I'm like, volume is not indicative of liquidity. Let's move on past that. But I did, as we wrap up here, I did want to say I've noticed you have done a lot of media. I was on your site today. So you have done a great job of getting yourself out there, getting on CNBC, getting on all the big networks. And so how has that kind of helped you tell the story to advisors, not just with PPI, but with other things? Do you see that as a big proponent to allowing your firm to continue its growth?
Yeah, I mean, I published institutional research for 20 years before I started Astoria. So I've had some relationships with the media, but to be clear, Brad, like Morgan Stanley, Merrill, Lynch, like they didn't care if I went on TV. Like it was about publishing research, getting institutional clients to like read the research, transact with these firms. Like that was very important, like drive revenues. So always kind of business savvy. What I would say is that in this world, like the buy side, you've got to have like a presence. So if you don't have relationships, how do you do it? Like once you start getting vocal on Twitter and people start following you, I think like these media personality guys would acknowledge you. So you just kind of got to get out there. But, it's not just me, right? There's a team behind me that empowers me. We've got 3 CFAs on staff, and we've got, full sales and marketing department. We work very well as a team. So I think, you got to have a good call. You got to be out there a little bit, and then you got to be right. So nobody wants to put you on TV if you're wrong constantly. So you better be right is the point.
Yeah. Well, John, this has been very helpful. And I really appreciate your time. Before I let you go, where can people learn more about PPI and also learn more about Astoria Advisors?
So if you go to astoriaadvisors.com or on Twitter at Astoria Advisors, that's the best way to find information about the firm, and you'll find information about all our solutions.
Okay. Well, great. John, again, thank you for taking the time for being here with us today. And I look forward to, having the opportunity to one day hopefully meet you in person.
Yeah. My wife's family's from Pittsburgh, so I'm there, once a year at least. So.
All right. Well, you'll have to shoot me a note, and I'm in New York probably 6 times a year. So maybe I'll run into you one day down on the floor. But again, John, thanks for your time. And I really appreciate you doing this.
Cool. Thanks, Brad.